Bismillahirrahmanirrahim. This is the first video on analysis of financial statements and financial conditions. In this video, we will solve exercises extensively on calculating debt burden, operating margin, current ratio and quick ratio, operating and total margin, debt service coverage, and times interest earned. We will also calculate days revenue in patient accounts receivable, program services ratio, and finally a comprehensive exercise on financial analysis ratios for a hospital from a trial balance. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We also hope that this video helps fresh graduates who have joined the governmental or not-for-profit organization and want to refresh their learning on analysis of financial statements and financial conditions. So let us start with solving an exercise on debt burden. The following information is extracted from a city's government's CAFR, that is Comprehensive Annual Financial Report. Compute the city's debt burden based on population and on property value. We have net direct debt, we have overlapping debt. Overlapping debt is the proportionate share of debt issued by other governmental units that provide services to that government's citizen. So we have a population and then we have full value of taxable real property, and we have to make separate computations for net direct debt and combined net direct and overlapping debt. Okay, so first of all, we have the net direct debt and we have the net direct and overlapping debt. Based upon population, the debt is 15,841. Then the population is 13,243. So the debt per capita will be the debt divided by population, and that will give us 1196. So the debt per capita is 1196. Regarding the net direct and overlapping debt, the debt is 27,983, and that is the net direct debt plus the overlapping debt, that will be 27,983. The population remains the same, 13,243, and the debt per capita will be the total debt, net direct and overlapping debt, that is 27,983 divided by the population, and this will give us 2,113. Then based on full value of real property, now we have done right now for the population, and now we are going to go for the real property, and the real property is 484,481,000. So we have the debt as it was in the previous case for the net debt and net direct and overlapping debt, and the debt as a percent of full property value will be the debt divided by the full value, and that is equal to 3.27%. And for net, direct and overlapping debt, the debt as a percentage of full property value will be 5.78%. Next, let us solve an exercise on operating margin. Now, the following information is extracted from a village's governmental funds statement of revenues, expenditures, and changes in fund balances. Amounts are in thousands. We have total revenue, total expenditure. We have excess or deficiency. You can see we have deficiency in the case of debt service and library. There is transfer in of 850 and 225, but these transfer ins are in debt service and library. Then there is transfer out of 1075 for the general, and we have net changes in the fund balance. Compute the village operating margin for the general fund and for general, debt service and library fund aggregated. So the transfer out are routine transfers. They have given a note to the other two funds and should be considered as expenditures in calculating the general fund's operating margin. Because the transfers in are from the aggregated funds, they should be ignored in calculating the denominator for the aggregated funds operating margin. So first of all, operating margin is net change in the fund balance, and the net change in the fund balance is 153 divided by total revenues, and the total revenues is 8640, and we have to ignore the transfer in from other funds, aggregated funds. So the total, this will be equal to 1.77%. So the operating margin to general fund is 1.77%. Next, we have the operating margin aggregated funds, and aggregated funds are, aggregated means we have 153 of the general funds plus 34 of the debt service plus 6 of the library divided by the total revenue, and for the general it is 8640 plus debt service is 26 plus 15, that is for the library, and there will be no net transfers. So this will be equal to 193 divided by 8681, that is 2.22%. Next, let us solve an exercise on current ratio and quick ratio. So the following information is extracted from Alpha Hospital's balance sheet. We have cash and cash equivalent. So this is a current asset. Short-term investment is a current asset. Long-term obviously is not a current asset. Patient accounts receivable net is a current asset. Supplies inventory is a current asset. Then we have the current portion of the long-term debt, and this is a current liability. Long-term debt is not a current liability. Then we have account payable and accrued expenses, and these are current liabilities. So we have cash and cash equivalent, we have short-term investments, we have patient accounts receivable, and then we have the supplies, and the total current assets is 20,467,000. Then we have the current liabilities, where we have the current portion of long-term debt and accounts payable. So the total is 8,515,000, and the current ratio is current assets divided by current liabilities. So we have current assets and we have the current liabilities, and this will be equal to 2.4. Then number B, the number of days revenue in patient's accounts receivable. Alpha reported net patient service revenue of 76,245. So this will be equal to net patient service revenue is 76,245,000 divided by the number of days, that is 365. This will give us the patient service revenue, that is equal to 208,000 to 208,890. This is the revenue per day. Then they are asking for the net patient receivables, and the net patient receivable will be patient's account receivable net and divided by the patient service revenue, and patient accounts receivable net is 10,903,000. 10,903,000, and just now we have calculated the revenue per day, that is 208,890. So this will be equal to 52.19 days of revenue in receivables. So our receivables are for 52.19 days. Next, let us solve an exercise on operating and total margin, debt service coverage, and times interest earned. Now, the following information is extracted from Beta Hospital's financial statements. We have the revenue of 75,458. We have the expenses, and then obviously revenue minus expense will give us the operating income. To this we add the investment income. This gives us the total excess of revenue over expenses, and then they have also given the principal payment on debt is for 3 million, and they are asking us to calculate the operating margin, and operating margin is net patient service revenue minus the expenses, that is 71,455. That gives us 404,003,000. So we have the operating margin, and this is operating gain, and operating gain is 4,003,000 divided by net patient service revenue, and that is 75,458,000. So this will be equal to 5.30%. So the operating margin is 5.30%. We go to the next one, and in the second case they are asking for to calculate the total margin, and the total margin is excess of revenue over expenses, and excess of revenue over expenses is 4,503,000 divided by net patient service revenue plus net other revenues, and net patient service revenue is 75,458,000. There is no other revenues, and that is equal to 5.93%. Next, we calculate the debt service coverage, that is number 3. And this is excess of revenue over expenses, and excess of revenue over expenses was 4,503,000 plus depreciation, and depreciation is 3,765,000 plus interest expense, and interest expense is 2,200,000 divided by the principal payment, and the principal payment is 3 million plus interest expense, and interest expense is 2,200,000. So this will be equal to 2.01 times. Then they ask for, now so we have done number 3, debt service charge, and we come to the last part of this question, that is to times interest earned. Now times interest earned is the excess of revenue over expenses once again, and that is 4,503,000. To this we are going to add the interest expense, that is 2,200,000 divided by the interest expense, that is 2,200,000, and this is equal to 3.05 times. Next, let us solve an exercise on days revenue in patients accounts receivable. Now the following information is extracted from Gamma's hospital's financial records. We have the patient's accounts receivable, we have net, we have the gross patient service revenue, we have the provision for contractual adjustments, and we have to compute the number of days revenue in patients accounts receivable. So first of all, we will calculate the revenues per patient day, that is equal to net patient service revenue divided by 365, and net patient service revenue is gross revenue minus provision for contractual adjustment. So the gross revenue is given to us as 97,478,000, and from this we are going to subtract the contractual adjustment of 12,609,000 divided by 365. So this will be equal to 232,518. And finally, we are going to calculate the days revenue in accounts receivable. So we have the accounts receivable, and accounts receivable is given as 14,710,000 divided by revenues per patient day, that is 232,518, and this is equal to 63.26 days. Next, let us solve an exercise on program service ratio. A voluntary health and welfare organization obtains contribution to perform various social services. The following information is extracted from its statement of activities. So we have youth service program, senior citizen program, adult counseling program. So we have 3 programs, and then they have management and general fundraising. So the total expenses are 903. So compute the organization's program services ratio. So we have 3 programs, that means 89,000 plus 312,000 plus 248,000 divided by total expenses, that is 903,000. So this will be equal to 71.87%. So program service ratio is 71.87%. Finally, let us solve a comprehensive exercise on financial analysis ratios for a hospital from a trial balance. Okay. So following is the condensed trial balance. We have the debit column and we have the credit column and we have all the accounts over here. You can see that the question is long, so it is not, I'm not able to put it on one page. So this slide is going to cover only part A. So we have the information, and then they say the amount of long-term debt principal paid during the year end was 1800. This was the principal payment, and the current portion of the long-term debt payable on December 31 was 2000. So this is the current liability. Use the preceding information to do the following in preparation of calculation ratios. Compute the net patient accounts receivable. So net patients accounts receivable is patients accounts receivable, that is 14,700, and there is an allowance of 2,600. This will be subtracted. So the net patient account receivable is 12,100. Then the net patient service revenue. So the patient service revenue is given over here as gross 66,300. Then we have the provision for contractual adjustments, that is 7,100, and provision for charity care. So they are both, the provisions are going to be subtracted, 7,100 and 1,500, that is 8,600. So the net patient service revenue is 57,700, and this will be used in that discussion to follow. So I just make a mark over here. Next we have the operating gain, and operating gain is excess of revenue over expenses. Now the revenue over in our case is, how much is the revenue? Revenue is, just now we have calculated, 57,700. Then we have the operating expenses, and the operating expenses are 45,300. We have the depreciation expense of 3,200. Then we have the interest expense of 2,400. Then we have the provision for bad debts 1,300. Then there are other expenses of 1,700. So the total expenses are 53,900, and the operating gain will be the net patient service revenue minus the total expenses, that will be 53,900. So we are going to use this as well in our discussion to follow. So we have the operating gain of 53,900. Sorry, I made a mistake. Total revenue minus total expense will be 3,800. So this is the operating gain, and then we have, to this we are going to add the investment income of 200, and this will give us the excess of revenue of over expenses of 4,000. Then so that is the excess of revenue over expenses, and then we have to determine the unrestricted net assets at the end of the year. So at the beginning of the year, the net assets are given to us as 27,600. 27,600. To this we are going to add the excess of revenue over expenses of 4,000. So the total is 31,600. Okay. So this is so we have completed all the parts for part A, and we move on to the part B. And here they say compute the current ratio and the number of days on cash. So first of all, we are going to compute the current ratio. So we have the cash and cash equivalent as current assets, short-term investments. We have patient account receivable, but don't forget we will take the net, that is patient account receivable minus the allowance. And then what else we have? We have the drugs and supplies as well. So we have 4,700, 5,400, and then 14,700 minus 2,600 will give us 12,100. Drugs and supplies is 2,100, and the total current assets will be 24,300. Then we calculate the current liabilities, and the current liability is the current portion of long-term debt, and the current portion of long-term debt is first of all we have current portion of long-term debt is over here. Current portion of long-term debt, that is 2,000. Then we have accounts payable and accrued expenses. These are also our current liabilities, 5,400. Then we have estimated third party payer settlement, and you can see that is 2,300. So the current liabilities are 9,700, and the current ratio is current assets over 24,300 divided by, okay, let me put it here. Current assets are 24,300 divided by 9,700, and this will give us 2.51. Then number of days cash on hand, and number of days cash on hand, we are going to have the total expenses, and the total expenses was how much? Total expenses were 53,900. Total expenses are 53,900, and from this we are going to subtract the non-cash expense, that is the depreciation expense and provision for bad debts. So depreciation is 3,200 and provision for bad debt is 1,300. So we have 3,200 and 1,300, and this is equal to 4,500. So the approximate cash need will be the total expenses minus the non-cash expenses, that is 49,400. Then the cash needs per day is approximate operating cash needs, that is 49,400 divided by 365, that means we need 135.34 per day. Then next is we are going to calculate days cash on hand. So we have cash, and cash is 4,700 and short-term investments. So 4,700 plus 5,400 divided by average cash need per day, that is 135.34. So this is equal to 74.63, and these are the days cash in hand. So we have solved now part B of this exercise, and we go to part C now. And in part we will be able to solve C and D in this slide. Compute the number of days revenues in receivables. So first of all, we are going to calculate the revenues per day, that is net patient service revenue divided by 365, and the net patient service revenue here. Net patient service revenue is 57,700 divided by 365. So this is equal to 158.08. So this is the revenue per day. So then we calculate the number of days revenue in. So we have the net patient account receivable, and net patient account receivable is the patient account receivable minus the allowance, that is 12,100, and revenues per day is 158.08. so this is 76.54. Next, we go to part D, and they say compute operating margin and the total margin. So operating margin is the operating gain, and operating gain was operating gain was 3,800. So we have 3,800 divided by net patient service revenue, and the net patient service revenue is 57,700. 57,700, and this will be equal to 6.59%. So the operating margin is 6.59%. And next we calculate the total margin, and that is excess of revenue over expenses divided by net patient service. No, this should be this is a typing error. So divided by total revenue, divided by total revenue. So we have excess of revenue over expenses, and excess of revenue over expenses was 4,000 divided by total revenue, and the total revenue was how much? Okay, we have the net patient service revenue of 57,700, and we have the investment income as well of 200. So the total revenue will be 57,900. And this will be equal to 6.91%. So the total margin is 6.91%. Next we go to part E, and in part E they ask to compute long-term debt to capitalization ratio. So long-term debt to capitalization ratio will be equal to long-term debt net of current portion. So the long-term debt is 35,000, and net, that means we have to subtract the 2,000 that we are going to pay in the from the current liabilities for the current year. So that will be 2,000 divided by long term debt net of current portion, that is 35 minus 2 is 33,000, plus the unrestricted net assets, and we have calculated the unrestricted net assets as 31,600. 31,600. So this is equal to 33,000 divided by 64,600, and this is equal to 551.08%. Next, we calculate the debt service coverage, and this is the excess of revenue over expenses, and excess of revenue over expenses was 4,000 plus depreciation, and depreciation is 3,200 plus interest, and interest is 2,400 divided by principal payment, and the principal payment was 1,800 plus interest expense, and that is 2,400. So this is equal to 9,600 divided by 4,200. So that is how we calculate. Next, we have the times interest earned, and times interest earned will be and we can, if you want, we can convert 9,600. 1 minute. 9,600 divided by 4,200 is equal to 2.29. Okay. Then we have times interest earned, and that is excess of revenue over expenses, and we have just now seen excess of revenue over expense is 4,000 plus interest, and interest is 2,400 divided by interest expense, that is 2,400. So this is equal to 6,400 upon 2,400, that is equal to 2.67. So this is the last part of this exercise, and this completes our part 1 discussion on analysis of financial statements and financial conditions. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel, and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.